Trade should not be a weapon. These are Warren Buffett's exact words at the recent Berkshire Hathaway shareholder meeting. Buffett didn't mention Trump by name, but everyone knew who he was pointing at. Because what's happening now isn't just about policy, it's economic warfare. And for Singapore investors, many of whom are heavily exposed to US stocks like the S&P 500, QQQ, and the Magnificent Seven, the writing is on the wall. Stick around till the end, because we'll break down why Buffett is turning defensive, what this global shift means for your portfolio, and how you can protect your wealth in 2025 and beyond. If you want smarter money insights, subscribe to Wealth for You, and like this video to help more investors make informed decisions. Disclaimer: this video is for educational and informational purposes only. It does not constitute financial advice. Always do your own research or consult a licensed financial advisor before making any investment decisions. Part 1. The Trouble Brewing in America. Since April 2025, President Trump has ramped up his trade war tactics, announcing 145% tariffs on Chinese imports, one of the most aggressive trade moves in modern history. China responded with 125% retaliatory tariffs, and the global economy instantly started to feel the shockwaves. The result? The US dollar plummeted to a 3-year low. Asian currencies surged. The Taiwan dollar had its biggest one-day gain in over 30 years. The Japanese yen and euro also strengthened significantly. There's now growing speculation of a coordinated effort among central banks in Asia to support their currencies, possibly even a currency accord that would restructure global money flows. In plain terms, the world is moving away from the US dollar. Once seen as the ultimate safe haven, the greenback is now being de-risked by global investors. And that is not normal. It's historic, and potentially the start of a much bigger shift in global financial power. Part 2. What this means for Singapore investors. Now, let's bring it home. As Singapore investors, many of us have built our portfolios around US assets, whether it's through ETFs like the S&P 500 and QQQ, or direct holdings in stocks like Apple, Nvidia, Tesla, or Amazon. These investments are in USD, which means your returns are exposed to two risks: the performance of the asset and the exchange rate between USD and SGD. So even if your stock goes up 10%, a weaker dollar could wipe out those gains when converted back to SGD. And the pressure is real. Foreign investors have been pulling out of the US. In just 2 weeks, they dumped over $14.2 billion in U.S. bonds. Even U.S.-based funds withdrew $11.4 billion from fixed income. This isn't a short-term dip. It signals long-term uncertainty about America's direction. And guess who else is pulling back? Warren Buffett. He's sold over $134 billion in stocks. And Berkshire Hathaway is now holding a record-breaking $347 billion in cash. That's not panic, that's preparation. And if Buffett is holding back, maybe it's time you reconsider your own exposure too. Part 3. What smart positioning looks like now. Let's get practical. Here are 5 smart moves Singapore investors can make today to protect and grow their wealth. First, rebalance your U.S. exposure. If you're overinvested in U.S. tech stocks, QQQ or S&P 500 ETFs, consider trimming. These assets are the most sensitive to rising interest rates, a falling dollar, and global capital shifts. Second, diversify into Asia-Pacific and global markets. As capital flows move away from the U.S., Asian and European markets may benefit. Consider adding Asia-focused ETFs, dividend-focused global funds, or even emerging market exposures. Closer to home, the Straits Times Index offers SGD-denominated income plays with less currency risk. Third, hedge your currency exposure. Don't let Forex quietly erode your returns. Explore SGD-hedged versions of US ETFs, or shift part of your portfolio into SGD-based assets like REITs or local bonds. Fourth, build cash and short-term reserves. Buffett's massive cash pile isn't just sitting idle, it's strategic. By building your own reserve with T-bills, cash, or money market funds, you gain flexibility to move when the next real opportunity appears. And fifth, think global. Stay grounded. You don't need to abandon U.S. investments entirely. But this is a good time to reassess, rebalance, and realign your portfolio based on real-world risks, not old assumptions. The global investing landscape is shifting, and so should your strategy. Closing thoughts. Protecting your future. Warren Buffett isn't panicking, he's positioning. And as Singapore investors, we should take that cue seriously. The US dollar is no longer the fortress it used to be. Capital is flowing in new directions. Diversification and discipline are more important now than ever. If you found this video helpful, please give it a like, subscribe to Wealth for You, and share it with someone who's still all in on the Magnificent Seven without seeing what's happening globally. We'll be back with more practical tips on hedging, REITs, dividends, and how to build cash flow that lasts. Until next time, invest smart and stay wealthy.